Hello, welcome to Strictly Money at the News Forum, where all voices matter. I'm your host, Saijal Patel. Big losses in the stock market have rattled investors, and with central banks around the world determined to tighten the monetary taps in an attempt to fight stubbornly high inflation, worries are growing that this will tip economies into recession. So what do you do with your money? Well, my guest for this show believes that while we're on the verge of a bear market, there are still some good investment opportunities. Sebastien McMahon is Chief Strategist at IA Financial Group, and he joins me now from Quebec City. Sebastien, great to have you on Strictly Money.
Great to be here, Saijal.
So I think it's fair to say there's a lot of economic uncertainty, and markets certainly don't like uncertainty. Do you think that the reaction that we are seeing is in line with the data and what the data is telling us?
Sure, and it's a fascinating time for macro and for the markets right now. And the second leg of the sell-off that we're starting to see here seems to have a lot to do with the real economic impact of inflation. So, for example, we had Target and Walmart coming out in their earnings calls mentioning that the demand for discretionary items is starting to be hurt, that it's costing them a lot more money to operate. So inflation is biting into their profits. So it's a difficult time. The economy is in a tougher place in 2022 than it was in 2021, and it's starting to be reflected here in the markets.
I know when you see, staples like that struggling with inflationary pressures, I mean, you wonder why, you understand why we've seen the sell-offs that we have seen. Sebastian, do you think a recession, though, is inevitable? And the second part is, we talk a lot about stagflation. Is that likely what we're going to see?
Well, I don't know if it's inevitable that we have a recession, but I think it's very likely that we have one, especially in the US. I think Canada's in a much better place, so maybe we could avoid it. But maybe just to frame this into space and time. So 2020, we had a pandemic and we had to shut the economy down. And if the governments and the central banks did not inject all of this money into the system, we would have likely had an economic depression. And believe me, this would have hurt much more than the 6.8% inflation that we have in Canada right now. So in 2020, a lot of money injected. 2021, we think that the patient was saved, the economy was alive again. And now in 2022, we're feeling the after effects or the hangover of the measures that we put in place following the pandemic. So we have maybe a chart that we could bring on the screen here, which is an indicator that we've been using for a good while. It's the monetary policy cycle. You know that in the world, there are many central banks like the Bank of Canada, the Fed in the US, the European central banks, and they all have they all have decisions of their own. So we built an index, which is the red line here on your screen, and that's the amount of central banks, the number of central banks for which the last move was a rate cut. So that moves the line down, and the line up rather, and the rate hike. Last time the last move was a rate hike, moves the line down. So the more central banks are hiking and hiking and hiking, the more the line will go down. And as you can see in the chart, it strongly correlates and even has a leading impact on the global economic cycle, which here is shown by what we call the global PMI, which is pretty much the global economic cycle. So early in 2022 and even late in 2021, we were already expecting a moderation of economic growth around the world, and we are seeing that it's coming out pretty much like clockwork. Now, the risks of a technical recession, meaning that we have at least 2 consecutive quarters of negative growth. In the US, that's very likely. In the Eurozone, that's pretty sure. Well, it's getting pretty high. Probably it won't be the kind of recession where we have booming unemployment because the labor market remains pretty tight. But I think it's very, very likely that we get there.
Okay. Sebastian, let's go back to inflation, right? Because it's front and center. It's the biggest economic headwind it seems like we're having, and it's still persistently high on both sides of the border. How do you think this plays out? And when can we expect to see relief? We have about 40 seconds to the break.
Yeah, sure. So that's a tough question. And since we have now inflation that's led by food prices and by gasoline prices, this is mostly coming from the Ukraine and Russia situation now more than we had before with the supply chain issues. Central banks can't really do anything about that. So we're going to have some sustained inflation on food and on gasoline over the next few months and quarters. After that, let's see. But I think it's a return to 2% inflation. Maybe that's more a story now of late 2023 rather than late 2022.
Okay, we're going to take a quick break. Stay with us because a lot more to unpack here. We'll be right back. Welcome back. Sebastian, before the break, we were talking about inflation and mostly the fact that it's been driven by supply disruptions. In that case, do you think that the Fed and Bank of Canada have a good handle on this? And I guess my second question is, if it is supply driven, does raising rates make sense?
Yeah, sure. I think right now it's a mix of demand and supply, but it's getting more and more about supply. So central banks, what they can do is pretty limited, but they have to act because it's their mandate to control the rate of inflation. So I would advise them to go all the way to neutral on the leading rate, which is somewhere around 2.5% according to their work. But anything beyond that, if they go to 3.5, 4% on the leading rate, probably they're starting to do more harm than good if they go there.
Okay. You have mentioned that we are on the verge of a bear market, Sebastian. How much downside can investors expect?
Well, if we go into a bear market, history tells us that the median bear market is minus 24% from the peak, and the peak was in January 3rd in the US, and we're at about minus 18, 20% on this week. So there could be still 6-7% downside. The average bear market is minus 29%. So there's still significant downside and enough for anyone to act on it if they're still positioned with too much risk in their portfolios. I mean, if your portfolio prevents you from having a good night's sleep, it's not too late to remove some risk from there.
Yeah, I do want to talk about that. But I also want to bring up a second chart that you have. This is a chart that has the S&P 500 earnings versus the global monetary policy cycle. What can we take away from this one?
It's that earning expectations right now are much too high. And if we follow history as a guide, earnings from businesses listed on the S&P 500 will have to slow and even contract at some point later this year. Right now, this is not what's priced into the markets. The markets are still expecting very strong growth in earnings in the US, S&P 500, and NASDAQ. TSX, it's a bit lower, it's more moderate, but these earnings expectations don't really make sense. So if you go into a recession, even if it's a technical one in nature, usually you have a contraction of price earning multiples in the US that go down to below 15 times earning. Right now, we're at about 16, 17, 18, depending on the measures that you look at. So there's still some fraud. It's based on earnings expectations that are probably over optimistic. So this is why I mentioned that this is kind of the second leg. The first leg of the correction was rising rates hurting multiples, but now it's earnings that everyone realizes that are probably expected too high, and now you'll have to work through that. So expect some more downside as now reality, economic reality starts to hit the markets.
Yeah, well, it's interesting you say that because there are still a lot of investors that think that what we're seeing right now is a temporary blip and that there's buying opportunity. But you're saying, hold on, there's still more downside.
Yeah, there's always opportunities, in the market. So, for example, right now, if you want to be a bit more tactical, well, the defensive sectors, the utilities, if you have rates that are moving lower, there's always some places in the stock market that you can go in. If you shied away from bonds because bonds had a terrible year so far, now you're starting to see some life back into bonds, especially longer dated ones where you have a lot of duration. So there are some good opportunities there. The places that you need to avoid is where probably earnings or the state of future profits of businesses were overestimated. So some more speculative areas of the stock market and maybe even credit. Credit could be a bit under pressure, but if you go with federal government bonds, probably you have a good stretch ahead of you here.
Yeah, Sebastian, we have about a minute till the next break. You talked about bonds. What do you advise for those who are in, say, the 60-40 traditional balanced portfolio because they're seeing their equities getting hit, they're seeing bonds getting hit? What do you tell them?
I tell them to stay there. I mean, make sure that you are in line with your true risk profile. Everyone thinks that they love risks until, there's some downside in the market. So make sure that you're honest with that. You talk to your financial advisor. But historically, global bonds and global stocks, the years where both had negative returns, you had 2015, 2018, and so far 2022. So those are the only three events since 1977, since we have good data. So in the last 45 years, this is truly the exception to the rule. Typically, both give you positive returns in any given year, and the rest of the time, they tend to diversify each other. So stay there, make sure you're true to your risk profile, and it's not because we've had a bad start to the year that you should ditch this formula.
Welcome back to Strictly Money. I'm here with Sebastien McMahon of IA Financial Group. Sebastien, where are you seeing opportunities in the market then? And for those especially who are trying to inflation-proof their portfolio?
Sure. So inflation is everywhere, and in the markets, there are ways to protect your portfolio from that and to benefit from it. So historically, if you look into the research, what you see is that the best way to benefit from inflation is to buy the things that are causing the inflation. So it sounds very simple, but you can implement that. Right now, it's commodities, mostly energies, base metals, agricultural products. So these things are worth having a place in your portfolio. And if you're a very sophisticated investor and you can play with the derivatives, I mean, it's easy to have direct exposure. But if not, in being overweight the Canadian stock market, where you have a lot of exposure to energy, to materials, that makes a lot of sense. So even though the S&P TSX has been under some pressure recently, the energy sector, that's still a good place to be. The materials sector, that's still a good place to be. And you could have some outperformance even to the downside by holding these. You technically also, historically, you can put some other kind of more exotic strategies like trend following. So there are many things that you can do in there. On the flip side, right now, what we're seeing is that we're seeing tech stocks, which were the darlings of the last move higher, they're getting beat pretty bad. That doesn't mean that tech is dead at all. I mean, the technology stocks that we have right now, those are some of the biggest companies in the world, the Facebooks, the Google, the Apple. So these stocks at some point, when we do find a bottom, they will still be interesting. But I would tend to focus more on real world, real economy assets like commodities to benefit from the environment.
Yeah, I want to talk about those FANG stocks, right? The Facebooks, the Googles, the Amazons, because we have seen a massive decline. Do you think that it's worth a second look right now, or are valuations still very frothy?
Valuations are still elevated, but it's hard to value these companies that have no debt, that have a strong growth in earnings. They have a large moat, so it's natural for them to be pricey. When we look at the recent moves, of course, now we've seen these names deflate quite a bit in 2022, so that makes them more attractive now than they were at the beginning of the year. But again, if you have a very long-term horizon, I mean, it's probably right now buying some of these things in 2, 3, 4 years, you'll say, well, I bought them at a very interesting price, but there's no guarantee that in 2 weeks, 2 months, 6 months, they'll be necessarily higher.
Sebastien, are you starting to see signs that people are paying more attention to fundamentals? And I ask this because it feels like fundamentals were sort of thrown out the door, right? Like massive run up. Nobody seemed to care that, there are stocks that are trading at 300, 400 times PE. Are you seeing some maybe rational thinking in the markets now?
Yeah, fundamentals are starting to matter again, and that's a very, very good thing. So when money is basically free, so it means that when interest rates are at near to zero from central banks, then fundamentals, I mean, who cares? There's just so much liquidity in there, and you buy what's hot and you just follow the trend. In 2020, 2021, everyone was looking at, all right, the strong recovery, probably a long business cycle. So let's just pile up into the names that should lead the way there. But when we have rising rates from central banks, when we have the yield curve that gets flatter like right now, well, then you need to be a bit more careful with what you have to your portfolios. And then you need to think about, all right, so what's the prospects for the US consumer, the Canadian consumer, business investments? And then you need to be a bit more peculiar about what you pick in your portfolio. So yes, technicals, the fundamentals are getting more important right now, and that's a very, very good thing.
Sebastian, we have about a minute to the break. There's still a debate right now that it's a stock picker's market. And yet there's lots and lots of people that just hold the broad index, whether it's a mutual fund or ETF. For those who do that, what do they have to consider? What are your thoughts on that?
Well, if you hold broad indices and you don't go into stock picking, I mean, relative valuation from country to country or large cap versus small cap, that's what you need to look at. Like, for example, right now, the TSX is trading at a 12 times forward earnings compared to about 17 times in the US. In the US, the price earning is above the 10-year average, so the average of the last 10 years. Mm-hmm. In Canada, we are below. So these relative valuations explain a lot. Like the NASDAQ is still, I mean, it's been beat down quite a bit recently. We're down 30% plus, but its valuation is still above the 10-year average, while global ex-US stocks were below the long-term average. So valuation matters in the long run.
Welcome back. Sebastian, I found that when we experience these sort of big events, that there are lessons that are learned, right? And big shifts happen. So, when we had the great financial crisis, what came out of that was QE, massive money printing. We now have COVID. No doubt that that's going to lead to some policy shifts. What are your thoughts on that? And what sort of trends do you think we can expect?
Yeah, I think the next decade is going to be the decade of ESG or sustainable investment, not just even for investment like in what you buy on the stock market, but even in the way businesses do what they do. So sustainable investment, ESG, that's environment, social, and governance. So of course, a lot of importance is put on the E with very good reasons. So environment is front and center. So probably that led to some, to Canadian energy being left on the wayside. But now we're starting to realize that the S and the G is very important because, as you probably have seen in the news, people realize that there's more Russian oil than Canadian oil in global indices, or at least oil companies. So people are thinking, well, maybe environment is one thing, but social and governance is probably another one. So there's this movement, and also economically, you have maybe a deglobalization coming from COVID. So maybe people and businesses before were focusing on what's the cheapest, what's the greenest that I can get from suppliers, but maybe now there's going to be a focus on what's the safest and what's the surest. So big shift here.
Yeah. What do you think this means then for Canada and our prospects, considering we're so resource heavy and energy heavy?
Yeah, I think Canadian energy could actually be part of the solution here. We're seeing lots of investment into technologies like carbon capture. So we're a leader there. So the new jobs that are being created there's a strong emphasis on innovation. So Canadian energy, part of the solution looking forward. We're still going to need energy. We're going to need cleaner and cleaner energy. And as they're working on, having a better representation of these values, probably that should attract even more interest from global investors that want to have good social citizens, corporate citizens. And Canada, I think, will be a good destination for those investors.
Do you think oil's dead then?
No, I don't think oil is dead for now. At some point, of course, there's an expiration date probably on the use of oil. But I mean, Canada, we're resource rich, so there's always hydroelectricity. So there's other areas that Canada can benefit from this trend.
The other thing was, supply disruptions, right? And this has really highlighted this reliance on not just China, but low manufacturing regions. Do you think that's changing or will change?
Yeah, sure, sure. So I think probably we're going to be having more manufacturing activity done locally, just like every other country. I mean, it was good to outsource to other countries or to China for a good while, but now there's going to be probably this reappropriation. So that's what I meant with the deglobalization. I mean, every country will be focusing on its own supply chain to make sure that if another pandemic or another kind of event happens, at least you have more autonomy.
Okay. Yeah. And probably diversify as well, because I don't think nations have done a very good job diversifying where, their manufacturing base.
Yeah, yeah, exactly. Before it was focusing on the cheapest, the quickest to deliver, but right now probably, and this could be an economic headwind for a good while we rework through all of that. But in the end, that will make an economy that's going to be much more sustainable.
Yeah. And I should mention, Sebastian, you do a weekly update, if I'm right, on economies and markets. And where can viewers subscribe to that? I think we have a website link that'll come up.
Yeah, we have a website, ia.ca/economy. So we write the monthlies, quarterlies, and every week I record something like this where I discuss what's going on in the world and how to make sense of all of that. So you can subscribe directly on the webpage.
Okay, Sebastian, we really appreciate you coming on today. Thanks so much.
Thank you. Thank you. Great to be here.
Sebastien McMahon, who's the chief strategist at IA Financial Group. Well, that does it for this show. When we witness this type of market volatility, it can feel unnerving. But as Sebastian said, this is the time to do a check on your risk tolerance. And remember, investing in the stock markets are a long-term game. If you have comments or questions about this or previous shows, please drop us an email. We'd love to hear from you. Until then, stay well, stay wise, and stay wealthy. Thanks for watching.